What is the overall difference between trading stocks and forex? In the earlier section, we mentioned that the stock market is a centralized market, whereas the forex market is a decentralized market. For this reason, one thing we have to take notice is that there is no perfect way to measure the amount of volume actually being traded in the forex market. Even though volume is available from most forex brokers, it's derived from the broker's own data stream. Those numbers don't represent the total worldwide market volume. They are only partially meaningful and helpful as they represent a proportional measure of the total volume being traded worldwide. The second thing is that there is no uptake rule in the forex market. What it means is that the exchange requires that every short sale transaction be entered at a price that is higher than the price of the previous trade. That's why it's not convenient to short sell a security for retail traders, and most are not used to short selling. But there is no such restriction in the forex market. So forex traders can make profits easily by both directions. If we think a currency will increase in value, we can buy it. If we think it will decrease, we can sell it. With the market this large, finding a buyer when we are selling, and a seller when we are buying, is much easier than in other markets. When we look at this chart, it shows the price of a stock. It goes up and down based on its own independent value. Theoretically, stock prices can go up indefinitely as long as the earnings keep growing. On the other hand, when a company has financial problems or if it's close to bankruptcy, the price can be close to zero. But in the forex market, this concept is different, because when we are buying a currency, we are simply buying its strength relative to another currency. Let's think about it this way. The chart that we see on the stock chart is a price. But on the forex chart, it's an exchange rate. Obviously, it makes no sense if we spend US dollar to buy the US dollar. So in order to buy the US dollar, we must be selling some other currencies in exchange for it. For this reason, the forex market is volatile in the short term, because every currency is being compared with other currencies constantly. Lastly is the number of trading alternatives available. The forex market has very few compared to the thousands found in the stock market. This concentration on a few currency pairs gives us the advantage of being able to specialize and follow. Because rather than having to pick between 1,000 stocks to find the best value, the only thing forex traders need to do is keep up on the political and economic news. For instance, most scalpers will only trade euro because of its high liquidity, and become very expert on just one pair. Stock traders can decide to specialize just in a few very liquid stocks such as Bank of America or Bank of China. However, those strategies typically involve having to monitor the major equity index, such as the S&P 500 in the US, or the Hang Seng Index in Hong Kong, which makes the setup more complicated. So which is better, stocks or forex? It would be unfair to make an absolute judgment in favor of either one. It really depends on our character and preferences. Some traders naturally feel more comfortable with stocks while others with forex. For the long-term investors, stocks may be a better choice, because they can make spectacular price moves, and entries don't need to be so precise. There's more forgiveness in getting in a bit too early or too late, for example. But for traders looking to do short-term or medium-term trading, then forex with higher levels of leverage and liquidity available should be a serious consideration. Moreover, it also requires less capital, and the scanning and filtering process is simpler than shares as well.